Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and it's great to have you with me for another episode where we break down the biggest topics shaping today's financial markets in a practical, easy to understand way. Today's episode tackles a question that's been debated by professional fund managers, institutional investors, economists, and retail traders for decades, but it's becoming especially relevant as we head into another fascinating year for global markets. The question is simple: growth versus value. Which investment style is likely to come out on top in 2026? Now, if you've been investing for a while, you'll know that markets rarely reward one investment style forever. Leadership changes, economic cycles evolve, interest rates move, inflation rises and falls. Technology disrupts entire industries, and investors continuously reposition their portfolios based on new information. That's why today's discussion isn't really about trying to predict a single winner. Instead, it's about understanding the forces driving financial markets so that you're better prepared regardless of which investment style eventually takes the lead. So, whether you're an active trader, a long term investor, or simply someone who enjoys following financial markets, let's dive in. First, let's define exactly what we mean by growth investing and value investing. Growth investing focuses on companies expected to grow their revenues and earnings faster than the overall market. These businesses are usually innovators. They operate in sectors that are changing the world through technology, automation, biotechnology, artificial intelligence, cloud computing, cybersecurity, semiconductor manufacturing, robotics, digital payments, and software development. Growth investors are willing to pay higher prices today because they believe these companies will generate significantly larger profits years into the future. Think about many of the world's largest technology companies. Their valuations often appear expensive when compared to traditional financial metrics. Yet investors continue buying them because they expect future earnings to justify today's prices. Value investing takes almost the opposite approach. Instead of searching for the fastest growing companies, value investors look for businesses that appear undervalued relative to their intrinsic worth. These are often mature companies with stable cash flows, healthy balance sheets, consistent profitability, and attractive dividend payments. They may simply be overlooked by the market, temporarily unpopular, or trading at discounted valuations because investors have become overly pessimistic. Typical value sectors include financial services, banking, insurance, utilities, industrial companies, healthcare, consumer staples, telecommunications, and energy producers. Both investing styles have produced exceptional returns over different periods of market history. The challenge, of course, is determining which style is likely to perform better during the next phase of the economic cycle. So, why has this debate become particularly important as we move into 2026? The answer lies in the macroeconomic backdrop. Markets have spent the past several years adjusting to rising inflation, aggressive central bank tightening, geopolitical uncertainty, supply chain disruptions, rapid advances in artificial intelligence, and changing expectations surrounding economic growth. Every one of these factors influences investor behavior. And together, they become what many professionals refer to as the macro drivers behind style leadership. These macro drivers largely determine whether investors favor growth stocks or rotate into value stocks. Let's start with perhaps the biggest driver of all: interest rates. Interest rates affect almost every asset class. When central banks lower interest rates, borrowing becomes cheaper for businesses and consumers. Companies can invest more aggressively. Economic activity tends to improve, and investors become increasingly comfortable paying premium valuations for businesses expected to deliver strong earnings growth years into the future. That's one reason why growth stocks have historically performed well during periods of falling interest rates. However, when interest rates remain elevated, things change. Higher borrowing costs reduce corporate profitability, make future earnings less valuable in today's terms, and encourage investors to focus more on companies generating strong cash flows right now. That's exactly where value companies often shine. So, one of the biggest questions throughout 2026 will be whether central banks continue easing monetary policy or decide that inflation remains too persistent to cut rates aggressively. Speaking of inflation, that's our next major macro driver. Inflation affects virtually every company operating in today's economy. Moderate inflation can actually benefit businesses by allowing them to raise prices while maintaining healthy demand. But persistently high inflation creates challenges. Consumers begin reducing discretionary spending. Businesses face rising labor costs. Input prices increase. Financing becomes more expensive. Profit margins come under pressure. Historically, value sectors such as banking, energy, industrials, and utilities have often held up relatively well during inflationary environments. Meanwhile, cooling inflation tends to support growth companies because investors begin anticipating lower interest rates and stronger future economic expansion. Another major theme that simply cannot be ignored is artificial intelligence. Over the past few years, AI has transformed from an emerging technology into one of the largest investment themes globally. Technology giants continue investing hundreds of billions of dollars into data centers, advanced chips, cloud infrastructure, machine learning, and automation. Demand for semiconductor manufacturers remains incredibly strong. Cloud providers continue expanding capacity. Cybersecurity firms are experiencing growing demand. Software companies are embedding AI into virtually every business application imaginable. If these trends continue throughout 2026, growth companies may well continue outperforming. But investors should also remember one important lesson from history. Great companies don't always make great investments if expectations become too optimistic. Markets can sometimes price perfection. When that happens, even excellent earnings reports may fail to satisfy investors if expectations have already become excessively high. That's why valuation still matters. Corporate earnings are another essential piece of this puzzle. Over the long term, stock prices generally follow earnings growth. Growth companies need to keep delivering strong revenue expansion. Investors expect innovation. They expect increasing market share. They expect expanding profit margins. And importantly, they expect management teams to continue executing successfully. Value companies, meanwhile, don't necessarily need explosive growth. Instead, they often benefit simply by proving that market expectations were too pessimistic in the first place. Improving earnings, stronger balance sheets, successful restructuring efforts, and stable dividend growth can all lead investors to reassess a company's true value. Now let's talk about economic growth. Economic expansion has historically influenced which sectors perform best. When economies accelerate, businesses spend more. Consumers spend more. Manufacturing activity increases. Construction rises. Banks issue more loans. Energy demand often grows. These conditions generally favor many traditional value sectors. On the other hand, slower economic growth sometimes leads investors toward companies capable of delivering above average earnings regardless of the broader economy. That's often where innovative growth businesses stand apart. They may continue growing because they're benefiting from structural changes rather than simply economic expansion. Geopolitics also deserves attention. Trade tensions, elections, military conflicts, energy security, tariffs, and supply chain disruptions all have the potential to reshape market leadership. Periods of heightened uncertainty frequently encourage investors to rotate toward defensive sectors that offer stable earnings and dependable dividends. As conditions improve, investors often become more comfortable moving back into higher risk growth opportunities. So, does all of this mean investors should choose one style over the other? Personally, I think history provides a very valuable lesson here. Markets rotate, leadership changes. The technology boom during the late 1990s heavily favored growth investing. The following years rewarded value investors. More recently, inflation and rising interest rates triggered another major rotation toward value stocks before enthusiasm surrounding artificial intelligence once again reignited growth leadership. Very few investors consistently predict every one of these rotations correctly. That's why diversification continues to remain one of the most powerful risk management tools available. Rather than trying to perfectly forecast which style will dominate every quarter, many experienced investors build portfolios that include exposure to both growth and value. This approach allows them to participate regardless of which style performs best while reducing concentration risk. Of course, maintaining diversification doesn't mean ignoring market developments. Quite the opposite. Successful investors constantly monitor inflation trends, interest rate expectations, employment data, GDP growth, manufacturing activity, consumer confidence, corporate earnings, and central bank commentary. These macroeconomic indicators often provide valuable clues about where market leadership may be heading next. For traders, understanding these relationships can also improve sector rotation strategies. When macro conditions begin changing, institutional capital often moves between sectors well before retail investors notice. Recognizing these shifts early can provide valuable trading opportunities. Before we wrap up today's episode, I'd like to share two resources that may help you continue building your market knowledge. If you're looking for a world-class, cutting-edge, and user-friendly trading platform designed for today's financial markets, visit crystalbellmarkets.com/platform. Whether you're analyzing price action, managing positions, or executing trades, having access to professional grade tools can make a meaningful difference in your trading experience. And if you're enjoying this podcast and want even more educational content covering trading, investing, macroeconomics, and financial markets, be sure to explore the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. It's packed with beginner-friendly discussions, practical market insights, and educational episodes designed to help investors and traders develop greater confidence as they navigate increasingly complex financial markets. As we conclude today's discussion, here's perhaps the biggest takeaway. The debate surrounding growth versus value isn't really about picking one permanent winner. Markets are dynamic. Economic conditions evolve. Innovation continues. Interest rates change. Inflation fluctuates. Investor sentiment shifts. And that's exactly why successful investing requires flexibility rather than certainty. Understanding the macro drivers behind style leadership allows you to look beyond headlines and appreciate the bigger picture. Instead of reacting emotionally to short-term market volatility, you'll be better equipped to recognize why capital flows between sectors, why certain industries outperform during different economic environments, and how changing macroeconomic conditions influence investment decisions across global markets. Whether growth stocks continue benefiting from artificial intelligence and technological innovation, or value stocks regain leadership through attractive valuations and resilient earnings, one thing remains certain. The investors who continue learning, remain disciplined, manage risk effectively, and stay informed about the broader economic landscape will almost always be in the strongest position to navigate whatever the markets bring next. Thank you so much for listening to Financial Market Insights for Traders. I'm Sophia, and I truly appreciate you spending part of your day with me. If you found today's episode valuable, be sure to subscribe so you never miss future discussions covering investing, trading strategies, macroeconomic developments, and the forces shaping global financial markets. Until next time, take care, trade wisely, invest thoughtfully, and I'll see you in the next episode.